Well, the athletic apparel and footwear industry has had a lackluster 2024. On Holdings' positive year-to-date performance, it's an outlier among some of its rivals like Lululemon and Nike, whose stocks have steeply underperformed so far this year. We're looking at how to navigate the industry with the Yahoo Finance playbook. And with us now, Zachary Warring, CFRA analyst. I should mention another one that's been to the upside this year has been Deckers. So it's been sort of a mixed picture here, Zach. But I want to sort of put it together here, because are we seeing macro headwinds to the consumer affecting especially the higher end so-called athleisure brands, or are we seeing more of a brand by brand execution reckoning here?
Yeah, well, thanks for having me. So I think there is a little bit of macro creeping in. I think it's even getting to the high income consumer at this point. You've seen some of the luxury names in Europe, report pretty disappointing numbers. But, I do think there are some companies that have been able to grow through this. One of those is On, and then like you said, Hoka as well. But I think it's overall, I think the sub industry is really dealing with some slowdown after, pretty big pull forward demand in 2021 and 2022.
So, Zach, what should investors be looking for when it comes to retail then? What companies are doing sort of the right thing from a management perspective if there is just a little bit of a consumer slowdown at play here?
Yeah, so you've hit on, two of the names that are obviously performing extremely well right now in terms of share price. But, we really like the companies that have been beaten down, that have really strong brands that we think expectations are extremely low, and then their multiples have come down significantly from the 2021, 2022 peak. So we really like companies like Lululemon. We think, here at almost 17 times the next, 12-month earnings, this is a, pound the table buy here, and then even Nike. So, Lululemon trades at a discount to even Foot Locker right now, which is pretty unheard of in the footwear apparel industry. So, companies like Under Armour and Vans or VF Corp, they trade at a higher multiple than Lululemon. And this is the first time Lululemon's traded at a 17 multiple since 2009. So we think this is still a great company. We think they're continue to execute. They're still expecting double-digit growth this year in terms of revenue, and then almost 30% growth in terms of EPS. So it's not like, they're going, you're not seeing a significant slowdown. They did hint at a slower U.S. consumer and maybe a slowing U.S. market for athleisure, but we still like the company.
And Zach, what do you make of the competition for Lulu, though? I mean, I walk around, say, the city, and I see Viore everywhere. I see Aloe everywhere. It seems like people are starting to make choices and just finding other brands in that space that Lulu dominated for so long. I mean, how much does the competition matter? I know the stock's cheap, but what does that mean for them right now?
Yeah, I mean, there is new competition. We won't downplay that. We don't think they deserve a multiple like they had 2 or 3 years ago. We don't think, they deserve a 35 or 40, forward multiple by any means. Like you said, there are competitors in the space, but we do think, I think it's been overplayed here, I think, to the downside, just because, I think investors have gotten a little bit scared thinking that they might, not grow anymore. But, estimates are still at 10 to 11% for this year in terms of revenue. And that's what the company's guided for. So it's not like you're seeing, a decline like some of these other companies are within the space. So, we don't think they deserve the multiple they had when they were dominating by themselves in the market. But we still think their brand resonates with consumers. They did lose their chief product officer in May, which is a hit, but we think that they'll grow through that. We think that company executes pretty well. We think it's not a end of the story for Lulu.
On the flip side, I gotta ask you about one of your stocks you don't like, and that is Deckers, which you referred to before, the maker of Hoka and Uggs, of course, because they've been kind of killing it. Is it just a valuation situation here?
That's exactly right. So Deckers is obviously performing extremely well. But their forward multiple and I think expectations for this company have gotten extremely high. And then in the last quarter, you saw a little bit of deceleration. So, they're still outperforming in EPS and revenue, but I think you're starting to see, some deceleration in the Hoka brand. And then it trades at an extremely steep multiple. And we think, the consumer's feeling really stretched right now. So it's just not one of those, if this was 2021 and everyone was flush with cash and consumers were still spending, on $150 to $200 pairs of shoes, we think they would be fine with this multiple. We have an issue with the multiple here.
Gotcha. All right, Zach, thank you so much. Appreciate it.